Okay. Hey, hello, everybody, and welcome. We're happy to be presenting at this year's Insuring Cannabis Summit. My name is Kieran O'Rourke, and I am with Cannasure Insurance Services, a division of 180, coming to you from the Cleveland area in Ohio. Hope you're doing well today. The topic I bring to the session today is one of risk management. And this comes into play in every business, in every place, but more so, I think, in the cannabis space, it is very important because in so many instances, the insurance available to the buyer doesn't quite meet the needs. And so how do you fill that gap? Well, you fill the gap with proper risk management. Now, these concepts, these techniques are tried and true, and they work across any risk or any business, whatever. But again, it's, I think, more important for the cannabis operator to be aware of risk management techniques and what they can do to fill gaps if insurance is not available, and just overall, just awareness of some of the things that risk management can do for your business. So let's get right into it. I have called this a flash primer on risk management, mainly because this topic could take days to go over and weeks even. I hold, among other things, the Certified Risk Manager designation, and that designation took a total of 10 days to get. That was 10 days of instruction, not counting the exams. So just kind of a disclaimer up front, we are going to be squeezing a lot of information in to a 20-minute presentation meant to just whet your appetite, to get you on the track to learn more, to find out more, to discover more about risk management and all the good things it can bring to your cannabis business. One thing to remember is that insurance is not risk management, and risk management is not insurance. Insurance products play a role in a proper, robust risk management program that you would have for your business. But let's not conflate the two concepts. Insurance is a tool, it's a transfer device. Risk management is more of a cultural approach to business. There's a term here that I think everybody should get to be comfortable with, and that is total cost of risk. Professional risk managers are focused on the total cost of risk, which includes the cost of insurance, but also the cost of everything else you do to minimize risk in your business. It's something that would probably be worth a 2 to 3 hour course alone. So we are going to touch on it here, and we are going to have you write it down and Google it later. Making risk management a part of your culture is very important, no matter how big or small you are. This isn't just a big company deal where we're hiring a risk manager, we have the money to do so, and so we're doing it. And smaller companies that can't hire somebody whose title is risk management or risk manager can't participate. No matter how big or small your risk is, your company is, your endeavor is, you can and should take advantage of some of the techniques and some of the concepts in a robust risk management program. So what is risk management? Well, there's a quick definition, I suppose. It's the process of making and implementing decisions that will minimize the adverse effects of accidental business losses on an organization. Now, notice it didn't say business losses that would have otherwise been covered by insurance but aren't covered by insurance. We have to think a little more globally here when it comes to a true risk management program for your business. But for our purposes here, we are going to touch a little bit more on the interplay with insurance because, as I've mentioned at the beginning, the cannabis space is you can buy a lot of insurance, but sometimes you can't buy enough insurance. And so what to do then? And this is where risk management can help to bridge the divide. All right, so making these risk management decisions involves a sequence of 5 steps. And this is where the tried and true part comes in. Risk identification is the first thing you want to do. You've got to know what you're dealing with first if you're going to do the other 4. So identifying risk in your organization is number 1. Then you need to analyze what you have found in step number 1. Step number 3 is the control aspect. What techniques am I going to bring to control this risk? And then once I have risks under control, well, how am I going to pay for them? Maybe it's a passive technique, maybe it's an active technique, maybe I transfer it. Maybe I transfer it to an insurance policy, maybe I transfer it to a non-insurance type of mechanism. And then finally, risk administration. What good project, what good endeavor is worthwhile if you're not going to keep tabs on it, if you're not going to nurture it, if you will. And so risk administration is something we'll be talking about in step number 5. All right, so let's just get into it. Again, this is a flash primer. We are not going to dive into the deep crevices of risk management. We don't have time for the purposes of this presentation today. So keep that in mind as we go over some of these things. Risk identification, these are all the things that will fit on this slide, but certainly not all the things that you can do. Checklists and surveys, product lists and raw material sourcing. You want to examine all of these things, identify all of the ups and downs in your supply chains and what have you, and where are the risks and what you can do to mitigate those. Compliance reviews, procedures and policies, and especially in the HR function. Again, we're going to touch on the interplay of risk management and the tool of insurance, but keep in mind that risk management extends to all aspects of your cannabis business, and the HR function is where a lot of good can be done with proper risk management. Your contracts, your warranties, your loss data, all of these things are good ways for you to identify risk in your business, including walking around, the time-honored tradition of simply walking around and seeing what's going on. So I put that in there as a kind of obvious reminder of something that is easy to do. All right, moving along to step number 2, risk analysis. So you've identified, and now you've got to analyze these things that you have found. Now there's 2 main ways that risk is analyzed. Qualitative analysis is things like modeling and simulations. It's maybe a little bit of hard science in there, some numbers, use of computer programs and what have you. You want to make everything from financial assessments to loss data assessment. Qualitative techniques are one of the 2. The other is quantitative analysis. Quantitative analysis takes the form of your loss projections and forecasts, things that are not easily read on a financial on a balance sheet or a income statement. You're projecting, you're forecasting the cost benefit analysis of doing anything. Perhaps if the risk is introducing a new line of vapes or simply deciding to offer vape products to something that you're already doing. A cost benefit analysis is a example of the risk analysis that you do when you decide to take on a new product or to develop a new product for your line. And of course, the strengths, weaknesses, opportunities, and threats, the SWOT analysis is a prime example of quantitative analysis that you would want to do as you analyze risk. So qualitative and quantitative analysis are 2 of the main types. All right, let's move on to we'll move on to risk control here. All right, so again, in the insurance realm, we talk about having insurance losses, and while this slide speaks to simply losses and not quite insurance losses, maybe what we'll do for the purposes of today's talk is to talk about insurance losses primarily. But certainly, if we talk about a business out in the world making product, earning money, being out there, risk, the higher the risk, the higher the reward, right? And if you take a risk, there's always a chance at winning, so to speak. Not a technical term for today's talk, but along with that, there's the chance of loss as well. So loss can take the form of many things: typical insurance type losses, fire, wind, vandalism, and also simply loss of income, loss of opportunity, what have you. So just keep that in mind. I keep touching on this because I want you to be thinking in in not only terms of the insurance aspect and risk management, but also in the larger scale of your cannabis business. So risk control, obviously two main categories: pre-loss and post-loss. Before you undertake, for instance, you can do any of these five. Maybe the decision is to simply avoid it. Prevention is a risk control. Pre-loss prevention is a great technique. Reduction, segregation, I'll get into that in a second. And then of course, transfer. How do you control risk? Maybe we just transfer it. Maybe we just avoid it. So an example might be you are thinking about doing a delivery. You're thinking about adding a delivery service to your business. Maybe it's your business to consumer. And so you want to think this through, and you've identified the risks, you've analyzed, and now you're in the pre-loss risk control mode of the idea of offering delivery service for your customers. Obviously, after the first two steps, your conclusion might be to simply avoid it. It's not worth the risk. If you throw up your hands and say, you know what, we've looked at this, it's not worth the risk, that would be risk avoidance. You have just done risk management. You have gotten to the risk control aspect, and you've said, you know what, we're just not going to do it. We're just going to avoid this. So that's one technique. Doesn't get you too far, but the numbers, both the qualitative and the quantitative analysis, might point to not worth it. It's not worth it in the risk to the business. It's not worth it in the income that we will realize versus the expenditures to do it that we will see going out the door. Prevention, you might get to the point where you say, we're going to do this. So a prevention risk control technique might be to increase driver awareness, driver training, to to have a few safety classes or what have you. Reduction, a risk reduction technique might be in the form of mandating seatbelt use, or making sure that the vehicle has proper airbags, not just front, but also side, perhaps. Maybe the vehicle should have a certain safety rating by some agency that does such things, or what have you. These would be risk reduction. Now, obviously, in my example, that would be on the personnel side. We also need to, protect the public as well. And we could go into other examples, but time is such that we must move on. Segregation is another risk control technique that one might use. Now, let's assume for a minute that in this risk control discussion, after the identification and the analysis, you get to the part where you're trying to control risk, and you decide, well, doing it ourselves is not right for us, but we still want to do delivery. And so we're going to go to the third party. We're going to go to a third party, and we are going to contract with that third party. And so a form of risk control would be, are you going to put all your eggs in one basket, hire one firm to do your delivery? What happens if that firm goes under? Segregation, an example of segregating the risk would be to hire two different third parties and kind of spread the risk, if you will, among two different vendors instead of just putting all your eggs in one basket. Another example might be your supply chain. If you are a manufacturer, or wherever you are in the cannabis space, you've got outside suppliers. And if you are with one supplier and there is a problem with that one supplier, you could find yourself in a tough spot, maybe for a day, a week, a month, a year. A risk control technique of segregating the risk would be to have multiple supply chains feeding into your business. And so segregation is spreading the risk, trying to make sure that you've got maybe even you could call it even a backup, if you will. Transfer is the final pre-loss risk control. If you are contracting with anybody to do anything really, and you'll, again, for the sake of this 20-minute session, just to keep it at a high level, risk transfer via contract is essential. not only for us in the cannabis space, but for really anybody. If somebody is doing some work for you, you have hired somebody to do work, whether it's simply fixing a hole in the drywall or putting a wing on your establishment, your manufacturing plant, your dispensary, what have you. You want to make sure that the contracts that are used to hire that work protect you to the fullest extent that they can, and we call that contractual risk transfer. So transferring the risk is the final one. We started out with avoidance, and we ended up with transferring, and we got everything pretty much in between too. So you can see the progression, the steps, the options that pre-loss risk control has. Now, very quickly here, there's post-loss risk control as well. That would take the form of claims management, litigation management, disaster recovery. Many times the claims are handled by your insurance carrier, and they are in control of that, but you are there at the table. You want to make sure that you have got as much information as possible. If something would lead to litigation, you want to make sure that you're in touch, that you're part of the information flow coming and going. And then, of course, disaster recovery, another great example of post-loss risk control. Of course, you have to have the disaster recovery plan in place pre-loss, so maybe that one belongs in both categories. All right, let's get on to risk financing now. This is step number 4 in our 5-step risk management process. So again, 2 main categories here in risk financing. Number 1 is retention and number 2 is transfer. Okay, so risk financing sounds like how we're going to pay for risk, and you can choose to retain it. You can retain the risk. And examples of that, I've got here on the slide, active and passive. Now, what would that mean? So active risk financing is, I guess to put it in simple terms, saving up for a rainy day. You actively will put money away. You will actively work toward what is inevitably going to be a loss that you're going to end up having to pay for. And so you've got, you have financial and other techniques to actively work on that risk financing. Passive then is the opposite. An example of passive financing would be going out on Black Friday to shop for Christmas with a credit card and having, the plan of paying it off when the bill comes. Passive would be, making sure that, or would be just dealing with it when it comes. Deductibles and self-insured retentions are forms of retention. To transfer risk, you would use non-insurance, you would use insurance, what you would buy insurance, or non-insurance would be the contractual thing we talked about. And then, of course, there's also alternative risk transfer mechanisms such as captives. All right, real quick, risk administration, implementation. You got to do it. You got to just get in there. You got to do it. You got to wade in, just do it. Make it a cultural addition to your business. And always make sure that continuous improvement is part of the deal. Lastly, monitoring, daily, weekly, monthly. It's everybody's job to monitor the progress of a robust risk management program. The administration part of this is key. You cannot get all the way through this and then drop the ball and not monitor all the work you've done on your risk management program. All right, we're coming to an end here. I've got 3 takeaways for you today. Learn more. As I said, this is scratching the surface, whetting your appetite, giving you some ideas. Learn more. Talk to your insurance advisor. That's probably a very, very good place to start. Think bigger. Think bigger. This is not just about buying insurance. This is about a cultural change for your business where everybody is a risk manager that extends far, the width and breadth of risk management is a little more than just buying insurance. So think bigger. And then finally, my advice is to just start, get it going, take that step, get out there and make your business even better. And just start. All right, everybody. On behalf of Cannasure, a division of 180 and Insurance Journal, I want to thank everybody for joining us today. I hope you've learned something. Obviously, if there are questions for me, your presenter, you can find me through LinkedIn very easily, cannasure.com as well. Questions, comments, what have you, I welcome them all. Thank you again for the opportunity to share today. Have a good day.